In this video, we're going to go over 5 dividend stocks that you can buy right now to generate some passive income. All 5 of these companies have a strong history of paying and increasing their dividends to shareholders every single year. And investing in strong blue chip dividend companies is the purest way to generate some true passive income. All 5 of the stocks we have in today's video have a current dividend yield of 3% or higher, and for each company, we're going to take a look at their current financial position, the historical growth of that dividend payment, and the current dividend safety score. But before we do that, I'm going to ask you to please hit that like button and subscribe to the channel. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any major market news or headlines. So please hit the like button, subscribe to the channel for daily videos, and today we're going to focus on 5 different stocks that you can buy right now for some pure passive income. And I myself am a dividend growth investor, and my current portfolio sits at over $82,000. And every single holding in my portfolio does pay out a dividend, and that dividend payment grows to shareholders every single year. So I love dividend companies. I believe they can consistently perform very well over the long term. They're some of the most stable and consistent growers in the entire market, and I love my portfolio, and I continue to invest in these dividend paying stocks every single month. And right now we're going to jump in to the first dividend stock in today's video, which is Pepsi, one of the largest food and beverage companies on the planet, and is also one of the strongest dividend paying stocks that you can buy as well. Ticker PEP currently trades around $139 per share with a current market cap of $190 billion. And the current dividend yield for Pepsi comes in just slightly below 3% at this current level. Over the past 5 years, the share price has grown by more than 43%, and this has been one of the strongest dividend growth companies on the market for decades. They are globally diversified and currently operate in more than 200 countries across the planet. And they own 22 different brands under the PepsiCo umbrella that each bring in more than $1 billion of annual retail sales, which is absolutely incredible. Their total revenue streams are diversified across the world and across many different brands. And if we take a look at their product mix, you can see they own some of the most recognizable brands across America that are on every shelf of every grocery store you visit all across the country. They are nicely diversified into the traditional beverage and snack food brands, and they're also making new partnerships to focus on the healthy food alternatives. And the company just announced a new joint venture with Beyond Meat, who is a leader in the plant-based food market, and I believe this new team is going to create a company solely focused on providing consumers with healthy, plant-based food and beverage alternatives. And I love this for Pepsi. It really shows that they understand where the future of the snack food market is heading, and they're making great partnerships to get into consumers' eyes with new products. And if we take a look, throughout this global pandemic that we're still going through, many companies on the market have seen a massive decline in revenue. But Pepsi is the opposite. Actually, over the past 12 months, they have seen a slight boost in their total revenue. Even with restaurants shutting down and many of their revenue streams drying up, the fact that this company is nicely diversified all across the globe, they are actually able to see an increase in total sales throughout this tough time. No matter what's going on in the economy, people are still going to need to eat and drink, and those are the products that Pepsi offers all across the globe. And it just shows that if you want to invest in a strong blue chip dividend company, you want a brand that can be resilient to any type of economic condition, and Pepsi has proven over the past 50 years that they can do just that. And if we take a look at their current dividend summary, the yield is slightly below 3%, their dividend payout ratio is at 74% of their net income, and they're able to grow their dividend at around 7.8% per year over the past 5 years. And they also have a very impressive 48 consecutive years of consistent dividend growth. And if we take a look at their current dividend safety score, it comes in at a 93, which means it is very safe and very unlikely that we see a dividend cut coming from Pepsi anytime soon over the short or longer term. So I own this company in my personal portfolio. I plan to hold for decades in the future. I think they will continue to grow, continue to innovate and expand their product line, and definitely a company to take a look at for some pure dividend passive income. And now we're going to take a look at the second stock in today's video, which is ticker AVGO or Broadcom. They currently trade for around $450 per share, and the company's up more than 43% on the 1-year chart. Their current market cap is $180 billion, and the dividend yield is at 3.24%. And Broadcom also trades at a very low forward PE of only 16.9, so a ton of value from this fast-growing company. And of course, with many brokerages on the market right now that offer fractional trading, you do not need to buy one full share and can invest with as little as $1. So Broadcom is one of the leaders in the semiconductor industry, which as a whole is only expected to grow for many years in the future. And this company has major contracts with some of the largest tech brands across the planet, including Apple. And if we take a look, their top line revenue continues to accelerate year over year and continues to reach record highs even through a global pandemic. And they bring in a ton of cash flow each and every year. And if we take a look at their investor presentation, their total free cash flow continues to expand at a massive rate and has reached close to $11.6 billion through the fiscal year of 2020. And their gross margins on this business are incredibly high, reaching close to 73.5% over the latest year as well. And if we take a look at their current dividend, with a yield of 3.24%, it only makes up 54% of their total payout ratio, so a ton of room to continue to grow their dividend moving forward and reinvest back into the business. And what's really impressive about Broadcom is how fast they are able to grow their dividend. Over the past 5 years, they have grown their dividend at an average rate of 52%. That's incredible. Their average dividend CAGR has been 52% over the past 5 years, and I believe going forward, we can still expect some high double-digit growth rate from their annual payment for many years in the future. And if we take a look, the current dividend safety score is at 67, meaning it is safe, and we're not expecting a dividend cut coming from Broadcom anytime soon. This company continues to grow at a fast rate. Their share price is up more than 263% on the last 5-year chart, and their dividend is compounding at a massive rate year over year. Broadcom was the newest addition to my dividend portfolio, and I purchased 3 shares of this company. I plan to hold over the long term, collect my current yield at 3.2%, and watch it compound at a massive rate for many years in the future. And now if we jump over to the third stock in today's video, we have ticker ABBV or AVGO. They currently trade for around $104 per share and has grown 22% on the 1-year chart. Their market cap is $192 billion, and they have a massive dividend yield of just over 5% and trade at a crazy low valuation of only 9.8 forward PE. So a ton of value in this company that has a massive 5% current dividend yield for some huge passive income. And if we take a look, over the past month, the company is actually down more than 7%, making this a nice little dip if you want to start or add to an existing position. And if we take a look at their revenue, continuing to grow each and every year and has picked up over the trailing 12 months and topping more than $40 billion. And if we look at their dividend a little bit more closely, over a 5% current yield, their payout ratio is just under 50% of their net income. So once again, a very sustainable net income yield, and their 5-year dividend CAGR is at more than 18%. So you're buying into this company with a 5+% dividend yield, and that payment is growing at a nice rate each and every year historically over the past 5 years, and that is expected to happen for years going in the future. And if we take a look, their dividend safety score comes in at a 50, which is considered borderline safe. I do think that is more of a bearish expectation. I think it is considered safe at this current point and will be for years in the future. I think they're only expanding their product line. AbbVie's doing a nice job of diversifying away from a couple core products, and I think their revenue is going to bolster up, and I think their income is going to globally diversify over the next few years as well. So definitely take a look at this company, a pharma name with a 5+% current yield that grows at a nice rate, and again, a beautiful stock for consistent quarterly passive income. And now moving on to the 4th stock in today's video, we have Verizon. The company currently trades for around $55 per share and is one of the leaders in the communication sector. Their market cap is at $234 billion, and they trade at a very low valuation with a forward PE of only 10.9. And the current dividend yield on this business is 4.55%, which is massive. And all the innovation and growth with regard to 5G networks are only going to expand the opportunities for Verizon to generate more revenue. And if we take a look, the company has plans to use their 5G technology and put it in NFL stadiums, different music venues, and even work with UPS delivery drones. So as a whole, the company has much more opportunities with the use of their new 5G networks than ever before. And this is a cash cow business. If we take a look, their current yield of 4.55% only makes up 50% of their total net income, giving them a ton of room to reinvest and grow their business, pay down some debt, and improve their operations, while giving them enough room to also grow their dividend for many more years in the future. And their 5-year dividend growth rate is at only 2.2%, but this is the definition of a slow growth blue chip dividend company that will continue to grow and pay that dividend for decades in the future. And one solid aspect of Verizon's business is that they have a ton of monthly cash flow that is predictable over the long term. And if we take a look, their dividend safety score is considered 87, which is very safe. So again, not really worried about a dividend cut coming anytime soon from this communication leader. And with their beta, it is considered very low at only 0.37%. So if you're buying into this company, the share price is not very volatile, you're not getting a ton of movement, and you're collecting a 4 to 5% dividend yield just to hold these shares over the long term. And I believe that dividend will continue to be paid out and grown for many years in the future. So definitely a leader in the blue chip category of very safe and sustainable dividends for passive income. And now finally, we're going to hit the 5th company in today's video, which is ticker DUK, Duke Energy Corporation. They currently trade for around $91 per share and have a market cap of just over $68 billion with a current dividend yield of 4.2%. And with Duke, this is a company that is known for consistent growth in revenue and income over the long term. And if we take a look at their income statement, you can see total top line revenue isn't expanding at a massive rate, but each and every year consistently growing as time goes on. And this company has a ton of long-term contracts that are predictable, and we can really understand the revenue coming in for many years in the future. And if we take a look at their dividend, this type of utility and energy company are all known for paying huge yields. With a 4.2% dividend and a payout ratio of 75%, which is actually very sustainable for a company in the utility sector, and they grow it at a 3.3% annual rate, so your dividend is slightly outpacing inflation each and every year, and I believe that will continue to happen for decades in the future once again. It's hard to actually beat out these well-established utility companies. They own the infrastructure, they own the cash flow, and it's hard for other competitors to come and take away their long-term contracts or the actual markets that the companies operate in. And if we take a look at their safety score, it comes in at 80, considered safe. So once again, another company where we're not too worried about a dividend cut coming anytime soon over the next few years. So those were 5 different companies who all can provide consistent and growing passive income in the form of a dividend. Always do your own research before investing into any type of company or any type of equity. Speak to a qualified professional and understand what you're getting into before you make your purchase. This video is for entertainment only. These are not recommendations. I'm not a qualified financial advisor, and keep that in mind when evaluating these 5 companies and if you want to make an investment into any of the names we discussed in today's video. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's episode.